Welcome to QX Financial. Today we are going to be showing you another customer of ours, another client of ours who came to us and we were able to show them some different things about tax diversification in retirement. So here we have our CEO, Junko. So welcome.
Hello.
All right. Go ahead and talk to us about this client and kind of some of the background and how you were able to help this client.
Excellent. Let's jump into it. I know we all of us talk about asset diversification, right? If you're planning for retirement, you have a portfolio, you need small cap, large cap, mid cap, international, real estate, blah, blah. Asset diversification. All of us talk about that. But one of the things that is almost never discussed is tax diversification, that you have money coming your way that is legally defined and treated in different ways by the IRS. That can create efficiency, save you a ton of money. So we definitely espouse and talk to our clients about asset diversification is key, is very important. But in addition to that, what I'm going to try to show you today is how financially important is also to talk about tax diversification, that we can help our clients reduce their tax liabilities into retirement. Now, what most people think about or not think about what most people are told is that, hey, don't worry about it. Income taxes in retirement are a non-issue. You're retired. You're gonna be in a lower tax bracket, so it doesn't matter. Well, that is only true if you want to have a crappy retirement. If you want to have very low income, if you want to live almost exclusively on Social Security, then yeah, you don't have anything to worry about when it comes to income taxes. But if, however, you're planning to become a successful individual and you want to have a successful and great income in retirement, you're going to have an income tax problem. And the best evidence that we have that this is true, why do Roth IRAs exist? Why do IRA to Roth IRA conversions or backdoor conversions exist? Well, they do exist because one of the most expensive things you'll ever pay for are income taxes. So I'm going to show you an example of how that will work. But tell us, Shirley, some of the very common FAQs that we get or feedback that we get, and we talked about using life insurance as a retirement tool. What do people say usually?
Sure. So right here on the screen, the biggest thing that pops out to me is use of life insurance, cash value life insurance. So whenever we talk to people, the biggest is, whoa, whoa, whoa. Life insurance is only for after I pass away. You don't use life insurance for retirement. That's just crazy. It's you can't use life insurance for retirement.
Exactly right. There's a lot of financial commentators out there that unfortunately I cannot name that tells you that life insurance is for losers, right? That you should not use it. But that's not the case. And I'm going to show you that if it's structured correctly, it can save you a ton of money. So let's dive into the numbers. So here we have a sample 1040, right? So we took some client information, we put it into the sample 1040 so that we don't share any private information. So all of you probably recognize this form because you fill it out every year, or your tax person fills it out every year for you, and you only sign it. So you'll see here all these different things that the IRS defines as income. So if you get interest, qualified dividends, IRA distributions, Social Security, any of those sources are legally considered income and therefore are subject to income taxes. So let's think about the average person. They have a 401k, they have an IRA. They actually never pay tax on it, right? Because it was tax deductible when the contributions went in, grew tax deferred over your lifetime, but now you hit retirement, you take a distribution. Now 100% of that is subject to income taxes. That's what this is showing you. So let's say the client takes out 100,000, right? That's what they took out from the accounts. It's coming from an IRA or any tax deferred account, 403Bs, 457, whatever it is. Because you're retired, you don't have any deductions. You see the 100,000 kind of go down in full throughout the form. Now, every single citizen in this country or person that lives in this country, taxpayer, gets a benefit, and that is called an standard deduction. So I'm using 2022 numbers because that's the example that we have here, but they're not that much different right now in 2024. If you're watching this in 2026, You can Google it, look it up. What is your standard deduction in 2028 or whenever you're watching this? But in 2022 and 23 it was 12,950. So what that means is that the first 12,950 that you earn are not subject to income taxes. If you're married, you can double that number. This is an example of single filing single, right? So we gotta deduct, we gotta take this $12,000 out of the conversation. So now your taxable income is only 87,000. We apply the tax brackets. We have a whole different video about how tax brackets work that you can watch in our YouTube channel. But as of now, just we apply this to the tax brackets, and that gives a tax liability of $14,768. Therefore, the spendable dollars, what the client actually gets to spend, is not 100,000, is $84,747. That's it. That's how this works. The question is, can we increase this number? Can we help a client have more income in retirement, more spendable dollars in retirement without having to go out there and trying to make a higher rate of return? Can we do that? And the answer is yes, we can definitely do that. And we do that partially through tax diversification. So let's say that we help the client set up a plan where now they can withdraw 50,000 from their IRA or 401k because they should have it, right? It's a good tool. But we build another side fund, so to speak, of income tax-free dollars. Could be a Roth, but in this case, we're using cash value life insurance. We have another video you can watch on our website and our YouTube page, the pros and cons of using a Roth and cash value life insurance. But in this case, we're using cash value life insurance. And we're going to design it to create retirement dollars, right? I like to call it cash flow. Why do I call it retirement cash flow? Because it's legally not considered income. If you go back to the list, life insurance is not on the list, right? Because whatever distributions you get from that while you're alive are legally not considered income if it's done correctly. So now, even though we're taking 50,000 from the qualified plan, IRA, 401k, and we're taking 50,000 from the life insurance, so even though we're taking 100,000, just like in the previous example, not all of it going to form because half of that is not considered income. So that means that we're only supposed or expected to report the 50,000 that we receive as income from the IRA or the 401k. Same thing as before. The standard deduction applies no matter where the income came from. So now instead of having to pay tax on 87,000, now our taxable income is only 37,000. And because the way the tax brackets work, we have a progressive tax system, right? So because the way the tax brackets work, you actually pay significantly less in taxes. So now your tax liability now is only $4,240. Look at your spendable income. It went up to $95,655. So what are we doing here? We were able to increase the client's spendable income that year by almost $11,000 without finding a better investment, without trying to be the S&P 500, without adding any risk to the client. All we did is we tax diversify all these sources of money coming to our client. And in this very example, by just going 50-50, we increase that value, I think it's like 12%. We were able to increase their income by 12% without really doing anything else. Now you may think, well, 10, 11,000 is not a lot of money. Well, take 11,000, multiply that for 20, 25 years in retirement. Now we're talking serious dollars here, right? So all we're trying to show you here is that, yes, asset diversification is important, but have you had the tax diversification conversation? I'm going to add one more thing to this, which is long-term care. Most people don't think about long-term care in retirement. We just did a case study here on our website that you can watch about that, right? How does that play into my overall retirement plan? That's also very, very important. So if we can help you find tax efficiencies, especially at a time when you retire and you have no more tax deductions, right? Your mortgage is paid off. Hopefully the kids are grown. There's no more college deduction. There's no more anything. You're retired. So if we can help you reduce the liability, especially exactly when you need it the most, now we can increase your income and give you a better lifestyle. Does that make sense, Shirley? Any questions, comments on that?
That sounds great. So one last question I have is if I am earning $100,000 right now. When I go into retirement, my advisor told me that I'm going to be able to live off of less. So, do I really need to have this kind of a tax diversification if in retirement I'm living on less?
That's a great question. Obviously, every case is different. So make sure that if you are watching these and you want to get a more concrete answer for your situation, there is a consultation button in the website. So click that, set up a time, and we can look into your individual situation. But what I will say is two things. Number one, if the client is planning to live in lower income, it still doesn't matter because if you pay less tax, you have more money to spend. So that still works, right? The only time where this becomes less relevant is if you're living under the poverty line. Because if you're living under $12,000 a year, then it doesn't matter, right? You're not paying any tax, so it's a non-issue. But if you plan to live with more than that, which is most people, then that's going to be a factor. And the other thing that I will say is that I know, when I took my financial planning classes, that we always talk about ratios. Okay, you only need 80% of your income. You only need 60% of your income. Those are heuristics. Those are rules of thumbs that we use. But have you considered inflation? Have you considered what's going to happen the next 20, 30 years? A lot of those rules of thumb are coming from a mindset of the last 20 plus years. I mean, it's been since the 1990s that we haven't had inflation over 3%. So that's 30 years of thinking that the world will remain the same. And last year, I think all of us got a wake up call when inflation went to 10%. That can also happen here in America. So if you're thinking about, I need flat income for 50 years or 30 years in retirement, inflation is a no problem. Market volatility is no problem. Taxation is no problem. You may want to reconsider the advisor you're talking to, right? You may want to reconsider the whole idea and get a more realistic view of what the world can look like over the next 20 to 25 years. And that's the way I will answer that.
Great insights. Now, is there anything else we can use besides a life insurance policy to kind of get the same effect?
For sure. I mean, obviously the Roth IRA is an option. And like I said, we have a video that goes over the plus and minuses of Roth IRAs. But the biggest one that we see as a potential minus or thing to think about is we can't put enough money to actually make it a substantial retirement tool. I think right now in 2024 is $6,000 a year that can be put into a Roth IRA. Whereas if I work on the life insurance side, I can put as much as I can afford. So if I'm talking to a client that is 52, 55, they need to catch up, $7,500 a year, which is your catch up contribution in a Roth IRA, it's just not going to make a dent, especially if they're successful, especially if they want a nice retirement. Now, can you do both? Of course you can. You can have a Roth and you can have casual life insurance and you can have some tax-free muni bonds. So life insurance is not the be all end all of everything, but because we can substantially fund it, that help us catch up for those people that either need to move money around or they're just behind in the retirement plan. They gotta substantially increase their savings. Then that's an area where an insurance account, again, if it's properly designed, can help us.
Right. That proper design is really key to any financial plan. If you have a really great financial plan and it's improperly designed, it's set up for failure.
Exactly right. It has to be realistic, has to be done within your means. Not the less wishful thinking we put into a financial plan, the better. So once again, every person is different. Every person has a different financial situation. Make sure that you reach out to us. We're happy to give you a second opinion or a first opinion on your situation. And we'll run the numbers for you and try to find the biggest efficiencies that we can in your financial plan.
All right, great. Well, thank you for joining us, Janko. We appreciate it. And we hope that you find value in this video. And if you have any questions, please click that button and set up a time when we can talk with you about your specific situation and see how we can help.
Perfect. Thanks, Shirley.
Thank you.